Continuing seamlessly from the previous lecture, how can we evaluate the business cycle, which involves analyzing a combination of economic and market indicators that provide insight into economic health, growth, and investor sentiment? The business cycle is typically divided into 4 phases: expansion, peak, recession, and trough. Here's an overview how asset classes perform during the phases. Let's start with the trough, or the start of the recovery phase. Let's characterize this state of the business cycle. The key indicators like GDP growth, after the figure hit the ground, it stabilizes and begins to turn positive. The unemployment rate remains high but stops increasing. Consumer confidence gradually improves. Corporate earnings begin to recover, and inflation is low but stabilizing. Interest rates at their lowest levels, with central banks maintaining stimulus. What do we usually see in the markets? The stocks, and here especially cyclical and growth stocks, begin to recover as investors anticipate economic improvement. Commodities, especially oil, the demand for commodities picks up, and currencies, risk-on currencies, start to perform better as we can detect inflows from safe haven currencies. With regards to high-yield bonds, risk appetite returns and yields are high. After the trough or recovery phase, we are entering the expansion or growth phase. What's happening to the key indicators? GDP growth is strong and accelerating. The employment rate is rising, so falling unemployment. Consumer confidence increases optimism about future economic conditions. Corporate earnings improve profitability, and there is rising revenue. Retail sales are robust due to stronger consumer spending. The inflation is low to moderate and gradually rising because of the demand. Interest rates typically low but may begin to rise as central banks anticipate inflation. What do we usually observe in the markets at this stage of the business cycle? Stocks, and in particular growth as well as value stocks, perform in general strongly due to rising corporate earnings. Commodities, especially oil, the demand increases as economic activity expands. And in the currency realm, risk on currencies, for example the Australian dollar or Canadian dollar, tend to perform well in line with the commodities. Gradually we are approaching the peak, so the turning point to contraction. What's happening to GDP growth? It slows and approaches its peak. Employment rates are high, but job growth may slow. Inflation is also high, potentially above target levels. Interest rates are rising as central banks tighten monetary policy. Consumer confidence may begin to falter. Leading economic indicators like the ISM manufacturing index show deceleration. In this phase, we usually start encountering headwinds, implying to position defensively. We can observe still a stable performance of value stocks, the ones that have a low PE and stable cash flows, as there is a shift to defensive assets like gold, investment grade bonds and safe haven currencies. In particular bonds, as yields rise, bond prices may begin to stabilize or dip. Hence there is a flow into shorter dated bonds, as there are not subject to duration risk, meaning their prices remain stable and they carry higher yields as before in the expansion phase. Gold may perform well as inflation concerns grow. As we are reaching the recession or contraction phase, what's happening to the key indicators? GDP growth might be negative. Employment rates are falling, so basically rising unemployment. The corporate earnings decline as revenues fall. Consumer confidence is very low. Inflation declines or may turn to deflation. And interest rates are falling as central banks implement accommodative policies. Credit spreads are widening, so basically the spread between the safe haven treasury bonds and the high yield corporate bonds. Accordingly, the main objective in this phase is to preserve capital. That means rushing into treasuries, gold, safe haven currencies. And on the contrary, to the peak phase where shorter dated treasuries are preferred. In this phase, longer dated treasuries are preferred as interest rates fall, implying that this duration effect kicks in and longer dated bonds are more sensitive to interest rate decreases or increases. Please check out the article after this lecture for a deep dive to gain further insights on asset class outperformance, commonly at play at each stage of the business cycle. Before we close this lecture, let's briefly emphasize on the length of the typical business or market cycle. The length of the typical business cycle can vary depending on a variety of factors, including economic conditions, monetary policy, geopolitical events, and technological changes. However, based on historical experience and economic theory, a general estimate for the length of a typical business cycle or market cycle is around 5 to 10 years, whereas the expansion phase is usually longer than the contraction phase, as well as the trough or full recession and the peak or full recovery last usually up to a year at best. For the sake of completeness, what are factors affecting the length of the market cycles? Monetary policy, central banks such as the Fed play a key role. For example, raising interest rates too quickly can lead to a sharp contraction, while maintaining low rates for too long can create an economic bubble. Technological innovation, such as the internet boom in the 1990s or the rise of artificial intelligence and renewable energy in recent years, can extend the expansion phase of the cycle. Geopolitical events, wars, trade, conflicts, and other geopolitical events can abruptly shorten or lengthen the market cycle by affecting global trade, commodity prices, and investor sentiment. Global economic trends, changes in global growth, emerging market demand, and the interconnectedness of global markets can impact the duration of the cycle. For example, a slowdown in China can have global repercussions. Government and fiscal policies like tax cuts, stimulus packages, or fiscal austerity can influence the economy's length and strength, of course, as well.